So let us broaden our vision at this point. I would ask Maurizio Esentato to take the challenge of just commenting on the global situation in credit markets and your perspectives for you and for your customers as well. Where are we going to go?
It's really a challenge. Good morning, everybody. First of all, let me thank you, everybody, because for us and for me in particular, it is always really food for thoughts to be here. I would actually introduce my brief talk, confessing that for us to invest in these markets, it is increasingly difficult. We are at the International Risk Management Conference. It is really a long time I take part into it, and I have to say that for somebody who actually started and implemented really as a discipline credit risk, it has been really, really difficult time, because it's years that we keep on seeing a risk. We try to be really rigorous and prudent, and we have to admit that it didn't pay off as we expected. Now, in order to understand the vulnerability of our system in the future, we have really to step back and to understand where we are. It's years that we keep on saying, at least in Classis, that we see risk. And to be risk-off or partially risk-off actually had a negative impact on the result of our performances. And it is difficult to be in front of clients to say where you came from. Now, let me tell you where we are in our opinion and why we shouldn't risk to be complacent. Because the risk that we are running now, at least in our firm, is to be complacent. Say, you know what? We said this many years, many times. It did not happen. Actually, a correction, even a small one, was a good opportunity to enter the market. Think what happened in the last quarter of last year. I want to be very frank, as we need to be in academia. We don't know why the market recovered at the beginning of the year. And I bet that most of the professional investor doesn't know either. Okay, you try to make a really understand the situation, but the reality is that we don't know the real reason. As we don't know why there was the correction, very abrupt one, we don't know why it recovered. We are happy. The market gave us very good performance. We are definitely very happy, but if I do not understand the reason why, I'm more worried than before. Now, in a capitalistic economy, still we are in capitalism, despite everything. The past, present, and the future are linked not only by capital asset and labor force, about the negative reading in US. Really not significant. But what we know is that what is important is a trend, or if a trend is going to change. So it's not only capital assets and the value of capital assets. Think about real estate market in Milan nowadays and think what it is now in London. Great opportunities look so for a value investor, for sure, in London. Difficult to say that now Milan is, in terms of asset price, a really interesting place to buy. So it's not only capital asset and labor force, but also is financial relations. Among intermediaries, among the trust that all and each players have one another. A bank working with a bank, so lending money, not doing individually, but doing as a pool. Pool loans are much lower compared to the past. Why? Trust, which is lacking. And the expectation of business profits determines both the flows of financial contracts to business and the market price of existing one. We come from record profits in the last 10 years. Every quarter, all the companies reporting, at least in Wall Street, saying that they reach a new record profit. Is it sustainable? How much they've invested? How much is the productivity? And the complexity of the financial structure is increasing dramatically. Think not only at the corporate level, but think about the government. We know something here in Italy. Now, the level of indebtedness is huge. What Professor Ullman said is scary. And instead, everybody look at things as if it's something now normal. It's a new normal. I mentioned yesterday, this time is different. I know, we said this probably last year, 2 years ago, 3 years ago. Is it going to last, this situation? The sustainability of the level of debt, which is huge. What Professor Ullman said is of extreme importance. 0.8 trillion, if I remember well, of corporate debt rated BBB in USA in 2008. 2.2 trillion nowadays. With the risk that fallen angel, so a BBB becoming a BB, what is going to happen to that paper, to the price of that paper, and who's going to do the market, the secondary market? I always try to get the pulse also from you, from what you have written, from your papers, of the current situation. And many of you are trying, and I would say rightly so, to understand why certain relationship or certain facts are happening in the market. It's not normal that when equity market goes up, also bond market goes up. Okay, it's different because, there is liquidity, there is QE. It's strange. But this is happening. And one of the papers that at least the title, I want actually to read it, did the Basel process of capital regulation enhance the resiliency of European banks? We hope so. But we don't know until the next crisis, I'm afraid. I was saying that the level of indebtedness is sustainable if the economic cycle is positive. And there is a lot of reading nowadays on the power and the capacity of the central bank, especially the Fed. Still, USA, at least for us, is really the benchmark of the markets. If there is a problem there, be sure that there will be everywhere else. Can the Fed prevent a recession? Is it avoidable or postponable? And if they are, I would say, right and successful in doing so, is it good for the financial system? What is going to happen when the next recession and the magnitude of the effects is going to happen? Okay, you know what? But this is a recovery, and it has been the sluggish recovery since World War II. So you know what? Now, in June is going to be as long as the longest one, 10 years. So this one is going to be the longest recovery. So you know what? Since it has been sluggish, it will continue. So this is actually the scenario. What is happening because this is what was actually asked to me, what's happening, what do we see in the market, in financial markets? To measure liquidity is not only a challenge. I think that if somebody can come up with a measure, is going really to get the Nobel Prize. I'll tell you what we see in the markets. QE depressed liquidity tremendously. In the market, there is no really liquidity, okay? The banking regulation has reduced the numbers of market players. So if you want to sell a bond, you don't find as many as probably you saw in the past. When I was a young professional in the city, and you wanted to sell a bond, you actually, through Bloomberg, you found at least 25 different market makers. Now it has become, and we are back really in an over-the-counter world. You have really to struggle to find somebody, despite all the liquidity in the markets, all the huge world of asset management. If you want to sell a bond, it's difficult, tremendously difficult. And this also applies to investment grade, not only high yield, and is somewhat scary. I'll finish just 1 minute. Yield is at a very low level. We struggle to find paper to give to our investor 1% for investment grade, reducing cost. Does it seem actually strange? We are professional. We have really to use quantitative technique to find out tens of bonds to invest. If you give nowadays an investor something like 2% net, they are happy. Does it seem strange? So, I want to conclude that risks are increasing, and we see too much optimism around. Not even a pretty much negative European election, negative in terms of result, because there is no really a defined situation. Change I would say the investment environment. Even Italy, actually, its spread reduced. Somewhat strange. I would say the excuse or the explanation is, okay, you know what? Still, it's an investment grade sovereign risk, and the risk premium is so huge, so much higher compared to Spain and Greece, that it's a great opportunity. You can't miss it. But you are, and we are at the International Risk Management Conference, you are, at least in our opinion, you are not discounting the risk. And when there is too much optimism in the system, from investors, from the banks, even from, I would say, regulators, this can become a risk. Thank you.
Maurizio, let me thank you for this clear and, I would say, straightforward presentation. I just wanted to just share with you a personal vision on the issue that closed your talk. Business International has carried out in the recent past, in March, April, an analysis, it's actually a beautiful analysis on the opinion of more than 600 CEOs worldwide on the key issues that they will have to face in the incoming months before the end of the year. And kind of a similar research was carried out by Duke and the CFO magazine on the Global Business Outlook survey, and the outcomes were more or less the same. CEOs and CFOs, what they basically say is that uncertainty, unpredictability, and volatility are the key issues that they have to deal with in their business environment, which is pretty in line with what you were highlighting. Risk is right behind the corner, but it's not yet clearly there. Probably, I don't see Menachem Brenner in this room this morning, but he, in the recent past, has been talking a lot about ambiguity, which is probably the key issue that we'll have to deal with. VIX index is not particularly high. Basically, it's low worldwide. But the thing is that risk is there, and we must be ready to face it. When Ed, a second ago, was illustrating the relationships, which were just scaring, between the non-financial corporate debt and the 4-quarter moving average default rate, that was really scary. That was really scary.